let's start with just the Chinese economy and what you know or what you think, given the warnings we've gotten from so many U.S. corporations, probably more to follow about weakness in their China business.
Indeed. I mean, there's no doubt that the spot numbers are weak. We can rattle through a whole series of statistics. We just had fourth quarter GDP, which is on the soft side. We had PMI below 50. We had the producer price index just hovering above zero, so concerns about deflation. I can rattle on, but clearly the spot characteristic of the Chinese economy is weak. The good news, the sort of glass half full, is that it's quite clear that Chinese policymakers are stepping up. I was in Beijing just on Thursday, had a series of macro meetings, and if you look at the various aspects of policy, be it fiscal, monetary, macroprudential, and then of course the fact that currency depreciated last year by nearly 10%, the combination of all those suggests that policy is easing, and with a lag that should begin to stabilize the Chinese economy.
That stabilization occurring, in your point of view, when?
Probably end of first quarter. I mean, our numbers are on a sequential quarterly annualized basis, 5.8% in Q1, ticking up to 6.2% in Q2, and then maybe 6.4 thereabouts in the second half, leading to a full year GDP growth of 6.2, down from last year's 6.6, but still within the 6 to 6.5 target range.
On a, what, a $15 trillion economy, roughly? Where are we?
Roughly a little bit less, about 13, 14 around.
Okay, so the U.S. goes into these latest round of trade negotiations feeling that it has leverage given the weakness you're talking about.
Correct.
Not to mention the various moves they're making against Huawei. Are U.S. negotiators correct in that belief?
I think so. I mean, I think it would be fair to also say that there's motivation on both sides of the table to have at least some sort of narrow agreement. You're not going to solve all the broader-based concerns and disputes between the U.S. and China, which were articulated more clearly by Vice President Pence on October 4th in that speech that was made. But you could have a narrow agreement on specific trade issues, but importantly would have to include intellectual property right and technology theft issues. And I think that's probably going to be the key sticking point, which remains to be seen over the next few days.
Do you think we actually get that this week?
I'm not sure that we would get a hard deal. I mean, our best case, our central case, which of course is just our best guess at the probabilities, is that there will be enough progress made not to have the United States go on March 2nd from 10% to 25% and that $200 billion of imports. So our central case now is a continued sort of pause or delay, a truce, so to speak, while some sort of a deal is ironed out. I think it's fair to say that a week or two ago, the odds of that appeared somewhat better given just the accumulating news flow. With the most recent news flow, I think the market's a little bit more jittery about that. And our key point from an equity market standpoint is that with the market having risen 8% year to date, in tandem with all the other, global indices, that the asymmetry that we identified at the beginning of the year in Chinese equities is less distinctly positive. So we still like China, we're overweight, but I think it's fair to say with the market having risen, with the news flow we just covered, that the outlook in the near term is somewhat more balanced than just distinctly positive.
It seems like as the longer the trade issue and the China slowdown go on, there's these two debates that have risen. One is how much of the China slowdown is specifically related to interruption of global trade flows because of the tariffs, and will the Chinese stimulus efforts to fight this slowdown be effective?
Right. I mean, and those are super topical questions. So let's just unpack that. I think in terms of the slowdown in China's economy, part, but definitely not all, is related to the external friction, the trade war. And I think the two ways we can exemplify that would be, number one, that China's domestic policy was kind of too tight during last year, and they may have overstayed that given the external shocks that we saw with slow down the global economy, plus the trade friction. And then number two, their whole series of macroprudential regulatory constraints were put in place last year, which also served to both slow the economy and undermine confidence, both on the consumer side as well as on investment. So I think there's definitely stuff that can be done on a domestic perspective, irregardless of what happens on the external front, to stabilize the economy. And in that regard, we are constructive. One of the indicators that our economists just introduced is a combined policy indicator, which blends fiscal, monetary, macroprudential, and so forth. And the key point here is that clearly shows some easing. Down on our graph is easing, up is tight. So it's clearly been easing. But if you benchmark that versus where we've been in the past, for example, 2015, 2016, that was much easier. So we think that there's still more they can and they should ease, and that gives us some optimism they can begin to stabilize the economy.
dealing with the dollar value of goods back and forth would seem to be fairly easy in terms of trade negotiations versus, as you say, intellectual property and things that are fundamental to the way the Chinese run their economy.
Right.
Do you really expect, I mean, they might make progress on it, but it could be years before they actually get to a full agreement.
David, I think that's right. I think and this is why we think that it's unrealistic and almost zero probability to say there's going to be one overarching deal that sort of ends everything and everyone, quote unquote, kisses and makes up. There still will be some areas of sort of agreeing to disagree and some friction, but there certainly is a potential, as you just said, for some very specific economic issues in terms of trade imbalance to be addressed, and then hopefully some progress made on the intellectual property right aspect. I think one of the key dynamics or issues is going to be how do you monitor? I mean, there's that well-known phrase, trust but verify, which is understandable from the U.S. perspective, but obviously from Faye's standpoint, it's going to be more difficult to sort of impose that on China. And I think that's where the friction is going to revolve around, and that's probably going to be the tougher part of the negotiation.
And finally, Tim, how would you sort of characterize the Chinese consumer right now, given the news from Apple, given yesterday NVIDIA talking about gaming chips?
Absolutely.
Where is, I mean, in your opinion?
I mean, quite clearly the consumer's weak. I mean, you have to look at auto sales. There's just recently some numbers out that are quite weak, and the NDRC, parenthetically and importantly, has just announced measures to try to stimulate automobile consumption. Property restrictions are being rolled back somewhat, but if you look at a lot of indicators for various aspects of the consumer basket, many of them are weak. So I think there's a cyclical aspect to that. There's a mix shift aspect where people may be trading down to more, cheaper goods. But I think overall there's a kind of a psychological impact where people are concerned about, domestic policy being too tight, about all the headlines with external friction, and that probably weighs on consumer sentiment.